Welcome back. We're on segment 6.8, and in this segment we'll be discussing about other term liabilities. So please recall that we are in chapter 6. In chapter 5 we have discussed about the P&L account. We are right now in chapter 6. We are discussing about the balance sheet. So in balance sheet you will be having two items, that is the liabilities and assets. So we are discussing right now liabilities. So we have discussed that under liabilities there will be three major classifications, right? So owners funds, term liabilities and current liabilities. So we already discussed owners funds. So in this we have discussed two items, that is capital and reserves and surplus, and we have started discussing about term liabilities. So far in the term liabilities we have discussed secured loans, that is loans from banks, right? We have also discussed unsecured loans, and we have also discussed share application money. So we'll now discuss a few other items that can appear under the broad heading of term liabilities. And finally we have one more item left, that is deferred tax liability, which we'll discuss in the next segment, right? So right now we'll discuss a few other term liabilities. So the items that we are going to discuss in this segment are debentures, preference share capital, deferred payment credits and term deposits. All of them are classified under term liability. So whenever you see this item, any of this item in the balance sheet which you are analyzing, so in the CMA data, you have to classify this as a term liability, right? All these items are term liabilities. You may not find individual breakup, right? In the CMA data, you may not find all these items. But if you find an item called debenture, place this amount. If you don't find an item, you can club it under something called other term liabilities. There will be a provision for in CMA data. There will be a provision called other term liabilities. So if there is a special head for any of these item, you can put it directly, or if it is not available, you can club it under an item called other term liabilities, right? So in the previous segment, we have discussed about something called shares, right? Please go through that discussion once again. And shares, we have discussed that they are the shareholders are owners to the companies. So the shareholders will be contributing some capital, right? If the company goes for a public issue, they'll be contributing some capital, and thereby they'll become shareholders. They will become owners of the companies. Debentures are also a sort of funds raised by the company, right? So a company can raise funds by capital, the share capital which we discussed through shares. It can also raise through debentures. Now debentures is a debt instrument. Now, please remember, this is a equity. Shareholders are owners. The funds which the company has raised through public issue from the shareholders is an equity. It is the owner's capital. Whereas the debenture holders are not owners. They are not owners, right? They are just like banks. Who are banks? Banks are basically debt holders. They are lenders. So they give some amount, they will get back their amount plus some interest. They are not interested in the profit of the company, right? So debentures, the debenture holders are not owners of the company. They are just debt holders. So that is the difference between a share and a debenture. Share and a debenture means shareholder is a owner of the company. Debenture holder is not a owner of the company. So there are various types of debentures, right? You need not be concerned too much about it. So there will be convertible, non-convertible, redeemable, non-redeemable. So you need not be worried about it. I'm just mentioning it for you for sake of knowledge. Convertible means it can be converted into equity. So there will be a provision right at the time of issue that these debentures, after a particular period of time, say 5 years, they have provision. The debenture holder will be an option. They will be having an option to get this instrument converted into equity. So the debenture holder will now become a shareholder. He will become an owner of the company. So if it's a convertible debenture, it will be having an option for the debenture holder to be converted into a shareholder. So the debenture will get converted into equity, right? This is not required for you, just for the sake of information. Then redeemable, non-redeemable means redeemable debenture is say for example 5 years. So after 5 years this debenture is going to be redeemed, right? You're going to get back that amount. If not, it is going to be a non-redeemable debenture. So how are you going to classify the CMA? Since we said it is a debt, so how did we classify term loans from banks? So banks have given some term loans. So they will be classified based on the repayment period. So if some amount is due within 1 year, we classify it as a current liability. If some portion falls beyond 1 year, is going to be a term liability. Similarly, here also you are going to see whether it is going to be when it is going to fall due. So usually it is a term liability because debenture is a debt instrument. So all debts are usually long term. But some portion of it, say for example, if it falls within 6 months, falls due within 6 months, just like term loans. So say for example, in the balance sheet, the debenture outstanding is say 100 lakhs, out of which 10 lakhs is due within the next 1 year, right? And 90 lakhs is due beyond 1 year. So what you do in this case, in the CMA classification, take this 10 lakhs as current liability and take 90 lakhs as a term liability, just similar to the term loans from banks. So what you have to understand is debenture is an instrument. It is a debt instrument. It is not an equity instrument. Therefore, they are not owners of the company. The company has to repay this debt back to the debenture holders, right? And usually it is a term liability. Then there is one more instrument called preference share capital. We discuss what is a share, right? And we discuss all these are this equity is these are older owners. They are shareholders. The shareholders are owners of the company. So we can have one more type of shares. This is known as the ordinary shares. Right? These are ordinary shares. There's something called preference shares. Preference means what does it mean by preference? We have some priority. Preference means there's some priority here. Usually you're not going to see this preference share unless it is a very big company. Only large companies go for this preference share. For a small SSI borrowers or mid-sized borrowers, you're not going to find this preference share capital. But if you see it in case of large borrowers, preference share capital is also a capital. Preference capital is a share capital. We are saying share capital is of two types. One is a ordinary share capital, other is a preference share capital. So this you can classify it as a part of equity, right? Under the owners funds you have capital and reserves and surplus. So you can take it into capital. But then preference share capital can be of two types. So redeemable preference share and irredeemable preference share. So please note that redeemable preference shares are to be repaid after a specified period. So therefore it will be a term liability. So please make this distinction very clear. First of all, we'll see what is a preference share capital. Preference share capital, we said preference share capital is a form of share capital where it has got some priority. Priority over whom? Priority over ordinary shareholders. So share capital can be either the shareholders can be ordinary shareholders or preference shareholders. These preference shareholders have some priority. They have some priority over ordinary share people. So what is the priority? Say for example, the company declares dividends. Right? So when the company declares dividends, these preference shareholders will be first getting the dividend, and only then the ordinary shareholders will receive dividend. So that is one priority. So other priority is when a company goes to liquidation. So these preference shareholders will be the first to get the repaid their capital, and only then, if anything is left, only then the ordinary shareholders will be getting back their capital. So there are some priorities to the preference shareholders compared to the ordinary shareholders. Right? Here again you have a number of types like convertible, non-convertible, redeemable, non-redeemable, cumulative, non-cumulative, participating. Right? What is cumulative and non-cumulative? Say for example, the preference shareholders are eligible for some dividend, just like ordinary shareholders. So in a particular year, the company, for example, has not paid dividend. Say for example, it has not made profit, so obviously it cannot pay dividend. So if the dividend of this year, in which the company has not paid, gets carried forward to the next year, so cumulative preference share is the preference shareholders will be eligible for the backlog dividends. So since the company has made a loss in this year and could not pay dividend, they will be eligible for that dividend in the next year. So this year, next year, this is 2013, this is 2014. In 2014, they will be eligible to be paid not only the dividend of 2014 but also the dividend of 2013. So it gets cumulated. So that is one more type. So the types anyway you're not required to be aware of. But the point you have to remember is redeemable preference shares are to be repaid after a specified period, and therefore it's a term liability, right? So usually when you speak of equity holders, the shares, we said they have a residual claim in the sense that they are not going to be repaid. So they won't be repaid just like term loan. Term loans, for example, banks will be repaid after 5 years, 7 years. So term loan, so the raw material supplies creditors will be repaid after say 60 days, like that. So we said the shareholders, right, the equity, the owners will be the last people. So only when the company winds up, only then they will be getting their money back. So they're not someone who are going to repay it in the next 1 year or 5 years or 10 years. Only when the company gets winded up, only then they'll be eligible to be repaid. We discussed that. But then, so don't confuse that with preference share capital. Preference share capital, there's a type called redeemable preference share. If it is a redeemable preference share, it has to be repaid after a specified period. Therefore, it is a term liability. Now, you have to understand that irredeemable preference share, right, the preference share which never get repaid, that is similar to that equity, right? A preference share which never gets repaid is actually not permitted. That perpetual irredeemable preference share is actually not permitted by the Companies Act, right? So, as per section 85A of the Companies Amendment Act, no company can actually issue irredeemable preference share. So, when you speak of when you speak of preference share capital, it is actually a redeemable preference share. When you speak of in India, when you speak of a preference share capital, it actually means redeemable preference share, and this you have to classify as a term liability, right? So CMA data, preference share capital, they will be redeemable. So classify if it is 1 year, right? If it is due to be repaid after 1 year, classified as a term liability. But if the redemption of shares is falling due within say 2 months, less than 1 year, then it will be a current liability. Same as the case with term loan from banks. This we already discussed, right? So preference share is usually a term liability. If some portion of it is falling due within the next 12 months, then you can classify it as a current liability. That portion. So out of 10 lakhs, which is due, 2 lakhs is falling due within the next 1 year. So this will be a current liability, and the remaining 8 lakhs will be a term liability, right? And there is something called deferred payment credits. So this is a type of arrangement where the exporter grants the importer time to pay. So say for example a company has imported a machine, right? So this machine is costing 10 crores. This is a very expensive machine. So obviously to encourage to encourage sales of such type of machines, what the exporter will do is he'll provide an arrangement whereby he'll say you need not pay this 10 crores immediately. Please, you can pay this or just pay 2 crores down payment right now, 3 crores within 1 year, 5 crores before 2 years. So he'll be giving time to the importer to pay this 10 crores. So the payment is deferred. Deferred means it is postponed, right? So this is spread out over a period of 2 years. Immediately he need not pay this 10 crores. So from a balance sheet point of view, from the CMA point of view, since the company has to pay 2 crores immediately, so as on the balance sheet date, if you see an item called deferred payment guarantee 10 crores. So you have to know the breakup. So 2 crores is to be paid immediately. So 2 crores will be a current liability. And he says 3 crores is to be paid within 1 year. So even that 3 crores will be a current liability. So current liability will be 5 crores. The rest 5 crores will be term liability, right? So usually you will not come across this item. It's very rarely you come across this item, so you can actually ignore this. But whenever you see deferred payment credit, you can classify it as a term liability, right? Then you might come across a term called term deposits. So term deposits means, please don't confuse it with the bank deposits, right? Banks will be having some deposit schemes, right? Fixed deposits and all. This is not fixed deposits. Term deposits, actually we are speaking from deposits from public. So some companies, right, raise money from public. Earlier we have seen share capital. So share capital, the company can also go for a public issue, right? Public issue and seek funds from the capital. So if the issue is subscribed, they'll be getting an amount called a capital. So if a company has requirement of 100 crores, the promoters bring in 40 crores, they can go for a public issue for 60 crores, and some people will be subscribing to the 60 crores. They will be the equity shareholders. This is also raising funds from the public, but this is equity holders. These are owners, right? This raising from money, this term deposit which you are speaking, this raising of money from the public is a debt instrument. This has to be repaid. This need not be repaid, right? These are owners, right? If they want, they can sell the shares in the secondary market, in the stock market, and they can trade the shares. This is different. But they are actually owners of the company. There is no obligation to repay. Here, this is a debt instrument. So the term deposit which the company has raised from the public has to be repaid. So this is a debt. So usually you're going to classify them as a current liability or a term liability, just as in the case of term loans from banks, based on the repayment schedule. So in the balance sheet, if there is an item of 20 lakhs, you will see how much is falling due within the next 1 year. So if it is a 5 lakhs is falling due within the next 1 year, it will be a current liability. The balance 15 lakhs will be term liability, just as in the case of term loans from banks. You will actually very rarely come across the item because with there are many legal restrictions. This is not every company can go and go to the public and raise money from the public. This is not very common. There's a lot of legal regulations. I just going to show one example. Unitech is a company. Unitech is actually a real estate company. Usually Unitech has some deposit schemes. They are raising money from the public. So just I'm going to show you the Unitech website. So this is Unitech website. Unitech is actually accepting deposits from the public. So obviously it has fulfilled certain the norms that are required by the regulators to raise public funds. So Unitech has some fixed deposit schemes. So that is one company which is accepting deposits from public. So once if a company wants to raise funds from the public, it has to satisfy certain guidelines laid by the regulator, and once they are satisfied, they can raise funds. But actually this is something rare. In your normal analysis of balance sheets, you're not going to come across this term that frequently, right? Because there are a lot of legal restrictions. So whenever you see the term deposits from public, this you can classify it as a term liability. Sometimes companies receive deposits from dealers. Take for example a company like Bajaj. Bajaj is a automobile manufacturer. So they'll be having a lot of dealers, right? They'll be having a lot of dealers. So companies usually accept something called dealer deposits. So these deposits, the dealers have to be eligible to be coming under the umbrella of the dealership. They have to pay some deposits. So Bajaj, in the Bajaj balance sheet, in the balance sheet of Bajaj Auto, the deposits from dealers, right? It's a liability because the company has taken amount from the dealers and it has to repay. Maybe at the termination of the dealership. Maybe at the once the dealership terminated, maybe then it has to refund this deposit. So it is a liability, right? So easy whether it is a term liability or current liability. So when it is to be repaid, this is not to be repaid within 1 year or 2 years. This is actually the case of repayment arises only when the dealership is terminated towards the end. So usually it is a term liability. So whenever you see deposits received from dealers, you can safely classify it as a term liability, right? So with this we come to the end of the segment. So in this segment we have continued our discussion on the term liabilities, and we have discussed 4 items: debentures, preference share capital, deferred payment credits, term deposits. All of them are to be classified as term liabilities, right? If some portion falls due within 1 year, of course we are going to classify that portion, only that portion, as current liability. So we'll end this segment here. In the next segment we'll be discussing the last item under term liabilities, right? The last item under term liabilities, that will be the deferred tax liability, right?